Hey traders, welcome to Charts and Coffee, rocking the Viking mug today as we're waiting on probably some rather meaningless pre-recorded shenanigans from Powell today. And, of all the things that we have this week, Powell's pre-recorded comments are probably the least impactful. Tomorrow's FOMC minutes, GDP on Thursday, PCE, the Federal Reserve's pet inflation number coming up. So we have other things, I think, that overall may be more catalysts for volatility than whatever it is that Powell may or may not say in the pre-recorded comments today. So with that in mind, we'll just take it one step at a time in terms of the volatility events that we have coming up. Scheduled high impact, high volatility events, hot zones. They're listed in the notes that I send you all, the weekly notes, and we cover them in the weekly notes live show. And so eventually we'll name that thing, get some theme music going. But in the meanwhile, of course, let's just jump into some questions here today. It's pretty much ditto how we looked at the market yesterday. Where are the trends? How can we engage them? Be aware of the volatility. Do we want to be heavily positioned in front of Powell? If so, how do we position size smaller, right? It's just that easy. How do you control risk? You control risk via position size. So there we go. So let's get to the question, shall we? Well, let's do it. All right, kicking it off. Hey there, Zions. Is T, sure, let's jump over into T. Is T considered a honey badger within the XLC? Okay, so honey badger is, I think, some simpler and specifically John created lingo. Love it, which means that it just doesn't care. It's going to do its own thing. And honey badgers are typically relative outperformers. Now, I prefer an uncorrelated honey badger, Zion. So if I'm looking at any possibility of a honey badger in my life, they're awful cute. I want to see one that's not necessarily heavily weighted in the broader averages or within the ETFs, the sectors. Now, T, of course, is part of IYZ, is part of XLC. So it doesn't have the uncorrelated aspect to it, but yeah, it's absolutely doing something. 180, right? 180 from XLC, 180 from IYZ. So in that regard, I would say, yeah, it's doing its own thing. And that we would bestow the honey badger moniker to T. All right, next up. Hey there, Robert. Thoughts on DHR, Danaher, and Dow. All right, so two different corners of the market. Danaher, not super heavily weighted within the XLV, but certainly a top 11 name the way that I build out my multi-charts. And XLV is going to be a little bit weaker today. Now, all my cards on the table, XLV, XLF, I've gone with the tide here. So I don't disagree in terms of keeping an eye on Danaher. It's the weakest name within the XLV. It's a little spendy in terms of per put option cost. And there's so much weak in the XLV. So from the relative performance standpoint, and this is just the absolute easiest way to show this to you, when we look at XLV, look at all the wobbliness in XLV, but your clarity is really at the tide level and individually at Danaher. So whether you want to short the tide or that specific boat, I'm with you on that. Now remember, please, please, please be very careful because there's two tricky boats in XLV. One is BMY, which we see is going to open lower because it's fighting the tide. If the tide's going out, BMY is having to really just wide open throttle to outrun, to outpace that outgoing tide. mark as well. So be very careful buying bullish momentum in sort of, if you will, kind of referencing Zion's question earlier, the honey badgers of the XLV, because they're very distinctly different in terms of movement from the broader group. On Dow, do I like the Dow setup? Again, when I look at Dow, it's in a very similar situation. Is it in an uptrend? Absolutely. But is it in an uptrend in a corner of the market that's generally heading lower? And that would be also yes. So if I notice that XLI is moving lower and DOW is moving higher, or XLB is struggling and DOW is moving higher, again, there's no problem with buying the dip. But what I recommend is when you lack that synchronicity, let's get tactical here. When you lack that synchronicity between the underlying stock and the tide that it's in, the sector, the index that it's in, position size accordingly to acknowledge that Danaher is actually in sync more or less with its tide, but Dow is not necessarily. And the same thing goes with T. So it's really more of a position sizing, right? Some position sizing conversation. Seth says that mug needs some mead. You know, about a year and a half ago, 2 years ago, Seth, my husband and I were on a mead kick, and we were trying all sorts of different mead, and that's good stuff. Really sweet in some cases, but it's good. I get it. I get why the Egyptians and the Vikings dug that stuff. And what's not to like about honey? All right, next up, is it just me, or do these Fed people talk way too much? Here. All right, moving on. Yesterday, I said use a 2 and 5 minute chart. I use a 2 and or 5, right? Those are my two preferred day trading timeframes. That is correct. When I took your day trading class, I was using a 1. Why the change? So in 2020, now let's take a broader view of this. If you use a 1, 2, 3, 5, 6, 7, 9, doesn't really matter, right? What matters is in day trading that at the end of the session, you're going to be flat. So whatever time frame you're using, it should not be a huge needle mover. If a market, generally speaking, the indices, right, are in a strong trend, I'll usually dial it down to a 1 or 2 minute time frame. It works well. The more directional bias becomes tricky, and the more volatility and the less trend that we see, less organization or directional organization that we see, I'll start to lengthen my time frame a bit to compensate for not getting sort of hoodwinked and hooked, right, into moves that really may not have follow through. So, 3 or 4 years from now, if we're in some blazing uptrend, you'll see me go back to the 1 or 2 minute. If 5's as long as I go, by the way, 5's as long as I go. My favorites are the 2 and 5. And the 2 minute came from one of my mentors about 30 years ago. And he used to use a 2 minute, which was an unusual time frame. 1s and 3s and 5s, very popular, but 2. So why using a 2? He said it's smarter than the 1, faster than the 3. That's all I needed to know. I know how well this one particular mentor of mine day traded. So I added the 2 to my consideration. So it's really a matter of what are we dealing with in the broader structural trending volatility follow through world, and I'll adjust accordingly. So you'll probably never see anything other than a 1, 2, or 5 in the last 2 years. So I don't make these changes every month necessarily. The last 2 years, you'll see it's definitely a 2, 5. The year before that, we remember 2020, the halcyon days of 2020. Yes, 1 minute was fine. So thanks for the question. And I love when people ask, Rug, I studied you then, what's so different now? I love those questions because, you're going to find if you Google, a lot of folks Google some articles that I might have written in the late 90s or the early 2000s. And the first thing they usually say is, Rog, you're pretty consistent and used to do more momentum trading back then. And that's true. Momentum trading worked far better than it does now in the late 90s and early 2000s. And again, it's a reflection of what's happening in the market. But you'll see the wave was on there, the grab candles, things like that. So we try to stay consistent in the way that we're observing what we should be doing in the market, right? But I might pull a different club out of the bag, to use a golf analogy. So thank you for the question. All right. How do you use the CCI and MACD? They're just two different. They're just two different strategies that I use. MACD is really a more of a momentum tool for me, being above or below the zero line, and CCI is a tool that I use for trend reversals. One, two, three, down one, two, threes, and CCIs tend to work really well. So that's their job. All right, next up was Citi's move yesterday. Citi. So was Citi's move yesterday a good entry for a put? So we waited after the news came out about Grandpa Buffett, and I always mean that endearingly. When Grandpa Buffett revealed his position in Citi, ditched Wells, Citi moved higher. We waited a session for it to calm down, and we built a put position in Citi, which got absolutely rocked, just whack-a-mole yesterday. So we ended up scaling out of our most aggro position. I'm just looking at my positions here. We ended up scaling out of our most aggro position in Citi. So we took a paper cut on the uh, aggro, which was a 50-70. So I'll tell you where I got in, 50-70. And yeah, that hurt. It stunk. But remember, an aggro position is about 25% budget. It's about 1.25% risk to the account. That's, of course, barring significant gaps. This one, we got pretty lucky. This one did not gap through that paper cut. It gapped really close to it and then traded through. So it wasn't as challenging to manage as, we're going to talk about some, hey, you know what? Let's talk about some trouble spots in my book right now. It wasn't as problematic as the move in FXE and 6E, which, by the way, I'm still very bearish because macroeconomically, dollar is still poised to strengthen. We're seeing a little bit of market adjustment as the ECB is adjusting their monetary policy, European Central Bank. And Christine Lagarde, I think in a blog post, said that they're going to come out of the negative deposit rates. That's hawkish. That's bullish for the currency. And then they're going to think about rate hikes also. So there was an adjustment that traders made on the euro. The euro and the US dollar have an inverse or negative correlation. And there's your movement in UUP and in FXE. So ultimately, I still want to be long dollars. And then the reason for the movement is, of course, when other central banks, especially ECB, make adjustments to their monetary policy messaging, it's going to rock, of course, the euro, but it's also going to rock more so than any other currency, the US dollar. So those are some spots where, gaps can be problematic for trend traders. Actually, it's problematic for any kind of trader. No one's immune to gaps against them. Nobody. So now back to Citi. We're managing that one. Am I going to look at entering Citi? No. In fact, we're focusing elsewhere. And yes, Dustin, JP Morgan is fine to look at. It's a little spendier compared to things like Bank of America, Wells Fargo. There's some other corners of this particular, the XLF, right? That could be a little bit more budget friendly. I'm not a small account trader, gang, but I do teach a process over prediction, right? I do teach a process of looking at your account, looking at your risk tolerance, and building a trading plan, budgeting out what is an allowable amount of spend for your account and for really the way that position would maybe add to exposure to a particular theme. For example, if I'm going to continue to enter more XLF, I've got to think about position size. And I've got to reduce it. I've got to think about risk, because if XLF just rockets higher and crushes my puts, I don't want to be in a situation where I've really committed heavily from a size perspective to this one narrative. But there's not a lot not to like in XLF. Hence, the tide is great. JP Morgan's fine. Yesterday, I told the folks in the sector secrets and also in the futures room, and I think also in the options room, to give JP Morgan a second, because the typical historical volatility for JP Morgan's right around 4 points, and we were somewhere north of 6. It's beyond the norm in terms of historical volatility, and therefore it merits giving it a moment to pause. All right. So, that's where ultimately, when we think about um, how we're going to manage XLF, tide or boat, I don't think you can go wrong either way. But when the top 4, 5, 6 are so weak, why not go with the tide? So thanks for the question. Golden milk, good stuff. Turmeric is an acquired taste, isn't it? And I find myself putting way too much honey in it, and all of a sudden, I think, you know what? I could just use some coffee. But I do try to do some golden milk from time to time. Absolutely. I've heard great for inflammation, but definitely not a taste that I've acquired yet. Yeah. All right. Next up, Jas asks, thoughts on WMB? Will I get an answer? That's an interesting way to coax a comment out of somebody. All right. So WMB. So we have a position in WMB. And when we look at WMB, so let me tell you all what we have in WMB. On the 10th of May, we set up. So let's move that here. On the 10th of May, we sent out an alert to buy the August 19 33 calls. I'm just reading from the alerts I sent to the Sector Secrets Mastery folks. You went 50% budget on this. So decent sized trade, but limiting risk to about 2.5% of the account. The trigger was 34.05. So as soon as we hit 34.05, gang, this has been said in many ways from many traders over many years. Trigger and trade. No trigger, no trade. No trigger, meaning until the price gets to your specific level, there's no reason to buy the underlying stock or option. So in this case, when we hit 34.05, I want to buy the 33 call. So then we think about, all right, when do we hit 34.05? And whether we got it that day on the alert, which I don't know we got it the day of the alert. I think we definitely got it 2 days later. So on the 12th, with a 33.99 low, what do we get? The 34.05 trigger. So that gives you a little bit of idea of what we were entering based on. Then the target was 35.70. Now, all this is in the initial alert, right? So that's where the question comes from. So then when do we hit 30? Well, let me put another vertical line here. So you can see the progress of the trade. Everyone can understand what we're looking at. So here is the entry. And then we're looking for 35.70. So we hit 35.95 on the 17th. We hit 35.77 on the 16th. So really, if you missed the exit to scale out on the 16th, the market was very generous on the 17th, and even for a brief period of time, generous on the 18th. But by this third line, we're scaling out. Then we move to a break-even stop. Now, this is where what you pay for the option matters and why you cannot blindly follow another trader. You need a very specific plan that is built around your position size and your cost per trade, right, everybody? So when we pull back, now remember, we're at a break-even stop. So as the market plummeted from May 18 to 19, the only question that matters at this point is we've scaled out, we're at a break-even stop. So now the idea is, have I exceeded? Are we lower than the cost I paid for the option? All right. If the answer is yes, you exit. If the answer is no, you're still in. That's it. That's it. That's the way we manage trades. And because you're empowered to make those decisions because I've taught you the process, now you just look at what you paid for the option. Now, I don't imagine on that day, a lot of traders were at break even, maybe close, but some might have been, some may not have been. And so if you were, it's still a winner and a break even stop. If you weren't, it's still a winner. And now we're going to look for the second target. This is the kind of thought process and flexibility and self-directed trading that I really cultivate, encourage, hopefully support in the mastery. So I hope that answers your question, my friend. That is WMB, and that's an alert pretty much from the beginning to where we are right now, straight out of one of the one of our mastery trades. And then I showed you a couple of them that were struggling. City, paper cut, FXE, paper cuts. I don't want to just say, hey, we do nothing but win like a rap song. What is that song? All I do is win. I wish. But when we have aggro entries that are hitting their paper cut level, we need to scale out, right? We need to scale out. So we had a little bit of that yesterday too. All right, gang. And just like that, I am out of time. All right, gang. So as always, I'll see you here Monday through Friday, 9 to 9:20, answering your questions, going right down the line in order. So thank you as always for joining me for Charts and Coffee. Thank you for caffeinating and dominating. Thank you for putting in the extra study and work. I put you in some rare air, friends. So I admire that a lot. And I'll see you all tomorrow. Thanks for the thumbs up. Thanks for smashing that like button. Leave your comments and questions below. I'll see you tomorrow. Be good to each other.